Oh, how the mighty have fallen. Just 7 years ago, ExxonMobil was the world's most valuable company. But just yesterday, one of its biggest competitors, Chevron, overtook its market capitalization. It was a short-lived move, though. Exxon had a 5% gain today, helping it reclaim its top spot as America's biggest oil company. But our next guest is out with a big call on both of these names. He says these two energy titans should merge. Let's bring in longtime oil analyst Paul Sankey of Sankey Research. Paul, great to have you with us.
Thanks for having me.
I mean, this would be, talk about a mega deal. I don't even know where to begin. What would a combined company look like?
Well, they're about 130 billion, 140 billion each now in market cap. And as you know, Exxon formerly was about 3 times the size, 4 times the size of Chevron. And when I say recently, as early as only this year, January of this year, Exxon was double the size of Chevron. It would be a very, very big U.S. oil company, but it would also be one with a tremendous amount of balance sheet power. And one thing we like about the idea is that if Chevron was to take control, you could get better on the ESG front and really get rid of a public relations problem at ExxonMobil, where it's perceived to be for better or worse, well, certainly for worse, but rightly or wrongly, I should say, environmental public enemy number one. Exxon has a huge public relations challenge, and one solution might be, to end Exxon.
Would Michael Wirth, the CEO of Chevron, do this?
I doubt it. I mean, I think it's very difficult. I think that if this continues for another year or two, or even gets more in favor of Chevron, which is heavily preferred by the market, then it becomes a real possibility. So as of now, going into this election, there's zero chance that this could happen. But I think the point of the note this morning was that this is where we've got to with Exxon. This is the point of the crisis where Chevron is now bigger. NextEra is bigger than both of them, the renewables play. And the writing's on the wall for the next 50 years. These are 100-year companies. They have to think very big, and this is a big idea.
Hey, Paul, it's Tim. There's restructuring certainly rumored around Exxon, whether this is happening and in what ways it's happening. Is there anything here on CapEx cuts and costs that should make this stock a lot more interesting for investors that can be done internally in the short to medium term?
Yeah, in the short term, they're cutting costs as much as they can. I mean, we highlighted this morning that there's over $10 billion a year of just general and administrative costs in Exxon, which, of course, is such a huge company. So the first thing is to cut costs. Second thing is we think they should cut CapEx even further. Only as of a year ago, it was about $40 billion a year. They're trying to get it down to $20 billion a year. We'd like to see them go down to even $15 billion a year and not worry about growing. And then the biggest question, as you know, Tim, in the market is, do they cut the dividend? Are they going to keep trying to pay this enormous burden, $14 billion a year, 10% yield? They've said they will. The market doesn't believe them. If the market believed them, it wouldn't be at a 10% yield, or at least the market doesn't believe it's sustainable. If you can sustain it for 10 years, you're paid out for owning Exxon. So potentially it's super attractive if they can make it. But at the moment, the oil market is absolutely against them.
How does the landscape change, if at all, Paul, under a Biden administration for oil?
It's going to be very significant because you're going to be pumping a lot of money, obviously, one way or the other into the renewables sector. And where my clients are making money, believe me, is in renewables, not in owning Exxon. So the fact is that a lot of these renewable stocks still have relatively small market caps. And the amount of money that's being proposed to just be put into the general theme of becoming more carbon friendly is going to push some of these stocks to crazy valuations beyond anything that we've seen even up to now. So it should be at face value very positive there. And a lot of people think it could be very positive for the oil price, because if you're going to limit methane emissions, methane emissions, if you're going to stop drilling on federal lands, that of course is going to reduce oil supply. And people, whilst very keen to buy into renewables, are still driving gasoline cars and hopefully still will be taking planes around the place. So oil demand is going to stay up. And really, the governments are trying to address this from a supply point of view, which I think is wrong. And in doing so, you should have a disconnect between high oil demand and falling oil supply that we think will be very bullish for this sector over the next 5 years.
Paul, thank you. Good to see you. Paul Sankey, Sankey Research.
It's always a pleasure. Thanks for listening.
Guy, Chevron for Exxon. You like it?
I think Chevron's a better company. I mean, listen, you're probably talking about 120,000 combined employees. There's obviously huge job loss associated with that, I would imagine. I don't think it's going to pass. I don't think it gets through the proper legal channels or the regulatory channels to approve that deal. But what do I know? In terms of the stocks, though, real quick, although I think Chevron's a better company, I think in terms of the trade, Exxon might set up better. And we've said this for a while. Exxon just traded down basically the levels we saw back in March, bounced off that $30 level. I think for a trade, for the first time in a very long time, Exxon might be interesting here.
Karen, you know, I think it's interesting that Paul was outlining a scenario in which under a Biden administration, both renewables and big oil goes up because of that sort of demand disconnect. We drive fossil fuel vehicles and yet want to buy renewables in terms of investments. Do you sort of buy into that thesis?
Well, it does make me think, I could see the restrictions here, but it makes me think that Saudi Arabia will see this is our last, maybe not our last chance, but we're nearing the end of fossil fuels, so we should just pump like there is no tomorrow. So I think there'll be a disconnect between WTI and Brent to keep prices low, though.
Shepard Smith here. Thanks for watching CNBC on YouTube.